Last time I was here, we talked about GDP in 2011, so we'd had data for about half the year. Our pick for 2011 at the time was 1.9%, so we came in at 2.1. So I'll take that one, 0.2 a percentage point difference on GDP. That's not a bad outcome. So what are we forecasting for the current year? At the moment, we're looking for 2.7% growth. Back then, we were looking at around about 3.4. So some differences there, and explained by data that's come along. On the Aussie dollar, I couldn't believe this. I said to Hayden on the way down here, this time last year, for September this year, we were forecasting $1.03. It's almost right on $1.03. Now, that's an amazing forecast to have got 12 months down the track. We weren't right on interest rates, though. We thought the Reserve Bank would have higher interest rates by now and would be heading higher towards 5% by the end of this year. That hasn't happened. So I guess one question is, why hasn't that happened? And I suppose the answer to that is because we underestimated the slowdown in inflation in Australia. We now think in 2012 the inflation rate will average 2.2%. We thought it would average about 2.5 to 2.75% this time last year for 2012. Now, it's that slowing down in inflation that's given the Reserve Bank the room to keep interest rates down and actually to cut them over the last while, of course, to a cash rate at the moment of 3.5%. So I guess I'll give myself, a pass to a credit on that sort of outcome. A couple of great answers there, but a couple of misses as well. So let's start talking about the global outlook. And the first place to start, I think, is definitely going to be in Europe. So what's happening in Europe? And I guess the point that I start at the moment is how good is the work that's been done by the European Central Bank? You all will have heard that the ECB in the last couple of months have come up with a program of effectively rescuing the bond markets of a couple of really important countries, more important than Greece in terms of their size for the Eurozone. There we're talking about Spain, we're talking about Italy. And what you can see on this chart is first of all, this red line here. This red line is the yield on German bonds, as they're known. So that's a German bond. And you can see that if you want to lend your money to people in Germany, basically running off this left-hand axis, they'll basically give you nothing for it. That's a whole story in that to start with, right? The reason why that's the case is because investors think Germany is the safest haven in Europe. So they're prepared to park their money there in the knowledge that they're probably going to get it back. They've been less forthcoming about parking their money in Spain and in Italy, but from July, look what's happened to what they call the spread, which is a number of basis points more that Spain and Italy would borrow for versus the same duration bond. And you can see that the spreads have come right down since the ECB started talking about this. So I guess that's the first point I'll make about Europe. The first point is that markets are feeling much more comfortable that there's a backstop in place now, which will prevent a meltdown of the European economy and also potential financial disaster, a breakup of the Eurozone. So that's kind of the good news story, I suppose. The bad news story is that there's a lot more work to do. One of the key things about Europe that I think is sort of not widely understood is that the real reason they're having these problems is because there's about a 30% competitive difference between the countries in the south of Europe versus the countries in the north of Europe. Now, under normal circumstances, countries that have got differences in competitiveness, usually the exchange rate of the uncompetitive country would fall, and that provides a cushion for that country. Now, it probably also would be undergoing structural changes and so on, some real wage deflation, which would also help their competitiveness. But the exchange rate is a really important pressure valve. Unfortunately, in the case of countries like Portugal, Spain, and particularly Greece and Ireland that have already had rescue packages, for those countries, they don't have a pressure valve anymore because they've all got the euro. So all the adjustment has to go on internally. And this is going to cause a lot of pain and hardship in those countries for quite a long time. So I don't think that goes away in a hurry. I mean, I heard someone say recently, I think this is a really good way of thinking about it. So how long will it take the Europeans to get their house back in order? And the answer I heard was, well, if this is a 10-page book, we're at about chapter 3. And I think that's a good way of thinking about it. There's a lot to be done. In particular, in order to make this monetary union work, they need a fiscal and a banking union, and ultimately probably a political union. And that's not going to happen overnight. The fiscal union, the banking union, they're moving in that direction. There's just been a big meeting this week where they talked about more centralised supervision of the banks across Europe. But there's 27 countries in the European Union, and they've all got to agree to every one of these steps as they go along. So this is a process that's a very fraught process, one that's going to take a long time. Now, when you think about the political union, I just wanted to show you something here from a survey which I think illustrates just how different the peoples of Europe are, and particularly what different perceptions they have about each other. And this is from a Fair Income survey that was done just before the Greek election, where thankfully I think for the Europeans as a whole, they voted in favour of a government that was in favour of staying in the Eurozone. So this particular survey, one of the questions they asked was, who's the most hard-working people in Europe? And you can see here that most people nominated the Germans were, except for the Greeks. The Greeks actually think they're the hardest working. So when you hear that lovely French accent from Christine Lagarde from the IMF now on the radio, talking about how the Greeks should be working harder and paying more tax, then you realise just how difficult it is to put this whole place together. Now, I heard you say, Simon, and there are a few politicians in the room here, and unfortunately there's a rather nasty message for politicians here. Asked who has the most corrupt government across the Eurozone, most of them nominated Italy, except for the Greeks who nominated their own government. And I think, therefore, the message is that we like to blame our politicians for our problems. And I think that's pretty much a worldwide sort of phenomenon. But look, moving on from Greece, I guess we're also thinking about the bigger picture here, and one of the bigger picture things that's been happening is, of course, the Federal Reserve's quantitative easing, which was announced that they would be extending that a couple of weeks ago. So I just want to talk a bit about the US and the outlook, and I think the key to understanding what the Fed's done here is in this chart, because what this chart shows you is the US labour market. So these are monthly numbers that come out every month. This is probably the most important bit of monthly data that people all around the world in finance and economics and banking look at, because it shows you a sort of up-to-date measure of what's happening activity in the US. So very clearly, here's the recession back here that the US had. That's jobs growth in negative territory. For quite a long time now, they've been generating positive jobs growth. So the light blue columns here are private sector jobs growth, and there's a real story here as well. You can see that the dark blue columns, that represents government jobs, and because of the budgetary position that the US is in, they've been shedding jobs for quite a long time now. So that's been offsetting some of the private sector job growth. The bottom line is that the unemployment rate's been stuck at about 8% for quite some time now. So the Federal Reserve has a dual mandate. This is very important. The Reserve Bank only has one policy target. That policy target is to keep inflation 2 to 3% over the course of the business cycle. That's it. No more, just one target. And the US has two targets. Sometimes those targets are not complementary. In fact, they're at opposite ends of the spectrum. And their two targets are to keep inflation down, but also to get unemployment down. And at the moment, there's no sign of unemployment coming down. So it's important to understand it's not that the US recovery was actually stalling. The reason why the Fed has done this quantitative easing is to try and accelerate this pace of jobs growth to get this unemployment rate coming down. The Federal Reserve officials think that about a 6% unemployment rate is around about a normal level. Again, you can see why they've felt compelled to do something. Which brings me to this whole sort of issue of quantitative easing. And there's been a lot of talk about, quantitative easing does or does not work. So we decided, let's have a look and see which central banks around the world have actually done the most instead of quantitative easing. So just for that, you've probably all heard this term many times, just to explain what this means. What it actually means is they end up with zero interest rates because they've cut interest rates as far as they can. Their economies are still weak, so they want to stimulate their economies. What can they do? And the answer in economic theory is you can expand your balance sheet. So what you do effectively is to print cash on the left-hand side of your balance sheet, and you use that cash to buy securities out of the market on the other side of your balance sheet. And in doing so, you're effectively replacing those securities with cash. Now, the hope obviously is that that cash, some of it will be spent, some of it will be reinvested and so on. You'll trigger an increase in activity as a result of doing that. So we can go back and, if you like, normalise what all the central banks have done since January 2007 all the way back here. Why did I pick January? Because that's before the global financial crisis started in the middle of 2007. So that's why we picked that date. And you can see on this chart how much each central bank has expanded their balance sheet over that period. And the really interesting thing is that it's actually the Bank of England which has expanded its balance sheet by the most. They have had the most aggressive quantitative easing. Their economy is very weak, and I guess some people would say, therefore it shows that it doesn't work. I think it would be a hell of a lot weaker if they hadn't done it. So I think it has worked in the Bank of England's way. But the Federal Reserve is the second most important in terms of quantitative easing. This is before the latest round, which will push them up to, at the moment you can see it's running at about, let's say, about 240% increase in their balance sheet. So it's going to come up here to about 260% increase in their balance sheet. So sort of about there on this chart. So that's assuming that they spend their $40 billion a month for the next 12 months. Now look at the ECB. Got an economy that's in a lot worse shape than the UK economy. Haven't been as nearly as aggressive. Look at the Bank of Japan. Been in the doldrums now since about 1990. Very unaggressive central bank, and their economy very weak. Even that little illustration says to me that quantitative easing actually has helped the countries that have done it with a big splash. And certainly I think the Fed has learnt through this. The Federal Reserve has learnt that when you decide to take these measures, tell everyone about it. Get the news out there. Get the people interested. Get them borrowing the money, and that'll help your economy along. Now you'll hear people saying, oh, quantitative easing doesn't work. Well, I think it's already worked in the US case. Two of the most important transmission mechanisms for this policy is by increasing the price of equities in your economy, and that's particularly important in the US, where the exposure of your average household and business to the equity market is greater than it is in many other economies, including Australia. So the rise in equity prices, it's obvious in this chart since they talked about it back here, in July. Back here you can see the rise in equity prices has been pretty substantial. At the same time, a second really important transmission mechanism, the US dollar has fallen. The US dollar falls, that makes their exports cheaper, it makes their import competing industries more competitive. So already the quantitative easing that they've just announced, I think, is working its way through the system. It will generate an increase in jobs growth in time, and it will keep their economy going. So when I looked at our forecast for the US, by the way, for 2013, last time I was here we had 2.6%. What have we got now? 2.5%. So it's about the same. And part of the reason why I'm still confident in those numbers is because of this measure by the Federal Reserve, which I think means that the US will continue to gradually accelerate ahead.